Well, the decline of American financial power didn't begin with a war, a banking collapse, or a market crash, but with a quiet administrative decision made behind closed doors in Brussels in April 2024. No explosions, no emergency speeches, no market panic, just a legal distinction, just interest. On April 10th, 2024, finance ministers from the G7 met privately in Brussels. No cameras, no transcripts. On the agenda was a question unresolved for more than 2 years. What should be done with Russia's frozen reserves? Since February 2022, the West had frozen roughly $300 billion in Russian central bank assets. Not seized, not confiscated, frozen. The money remained immobilized inside Western financial institutions, about 190 billion euros at Euroclear in Belgium, over $100 billion at the New York Federal Reserve, and tens of billions more at the Bank of England and other European central banks. Russia couldn't access the funds, but legally it still owned them. For 2 years, those assets served as leverage. The implicit deal was simple. Negotiate end the war, and the money might eventually be released. Freezing was framed as temporary, conditional, reversible. That distinction mattered. It preserved the belief that the global financial system remained neutral, that central bank reserves were insulated from politics. By April 2024, that belief was breaking. The war had entered its 3rd year. Ukraine was running out of money. The U.S. Congress was deadlocked. European governments were exhausted. And leverage that never converts into action eventually becomes meaningless. So in that room in Brussels, a line was crossed. The G7 did not seize the $300 billion outright. That would have triggered immediate legal chaos. Instead, they chose something more subtle and far more dangerous. They seized the interest. The principal remained technically Russian property, but the annual income, roughly $3 billion per year, will be diverted to Ukraine. On April 30th, 2024, the decision was announced publicly. Headlines called it clever, proportional, just, punishment without confiscation, creative financial engineering. To the public, it sounded technical, minor, almost symbolic. Inside central banks around the world, from Beijing to Riyadh, New Delhi to Abu Dhabi, Brasilia to Singapore, the reaction was immediate and very different. Emergency meetings were called. Governors asked their legal teams the same question, independently, across continents. If they can do this to Russia, can they do it to us? The answer was obvious. Yes. From a central bank perspective, the distinction between principal and interest is meaningless. If another country can confiscate the income your assets generate whenever it chooses, you do not truly own those assets. You hold them at the discretion of the political system that controls settlement. That realization shattered one of the core assumptions underpinning the global financial order for nearly 80 years. For decades, U.S. Treasuries were considered above politics. They were the world's safest asset not just because the United States could pay, but because it would not weaponize reserves against countries that were not outright enemies. Yes, assets have been frozen before. Cuba, Iran, North Korea, Venezuela. But those were isolated, sanctioned states. The rules seemed clear. If you were a normal country with normal relations, your reserves were safe. Russia destroyed that assumption. Russia was not a financial pariah. It was the world's 11th largest economy, a major energy exporter, and a permanent member of the UN Security Council. And critically, it had followed the rules. It held hundreds of billions in Western currencies precisely because it believed those reserves were secure. They weren't. Every central bank understood the implication immediately. Reserves held in dollars, euros, or pounds were no longer neutral savings. They were conditional assets, dependent on political alignment with Washington and its allies. But central banks don't panic. They move slowly, quietly, methodically, throughout 2022 and 2023. Many hoped the freeze was temporary, a wartime exception that would end with a negotiated settlement. They waited. That hope died on April 30th, 2024. Because the moment the West decided to use Russia's assets, even just the interest, freezing became functional confiscation. And once that line was crossed, the message was irreversible. Central bank reserves could be used to fund wars against their owners. That is when the selling began. Not publicly, not dramatically, no press conferences, no headlines. But month after month, foreign central banks quietly reduced their exposure to U.S. Treasuries. The data is public, released monthly by the U.S. Treasury, but almost no one talks about it. From April to December 2024, in just 8 months, Foreign holdings of U.S. Treasuries fell by approximately $400 billion. China sold nearly $90 billion. Japan sold roughly $95 billion. Saudi Arabia sold over $30 billion. Belgium, often a proxy for Middle Eastern custodial holdings, sold $25 billion. The Cayman Islands, frequently used for Chinese institutional flows, sold nearly $20 billion. This was not profit-taking. It was not routine rebalancing. It was the largest sustained foreign reduction of U.S. Treasury holdings outside a global financial crisis. And it was only the first wave. Central banks never sell all at once. Doing so would crash the market and destroy the value of their remaining holdings. They unwind positions gradually, over years, minimizing disruption. What we saw in 2024 was caution, not panic. But the direction was unmistakable. For decades, foreign central banks were the marginal buyers of U.S. debt. The U.S. could run massive deficits, issue unlimited bonds, and global demand would absorb them. This was the foundation of American financial power, the so-called exorbitant privilege. But when foreign central banks stop buying and start selling, the system breaks. Because every seller needs a buyer, and the identity of that buyer changes everything. When foreign central banks were the marginal buyers, the system looked stable, even elegant. The U.S. issued bonds. Foreign central banks recycled trade surpluses into treasuries. Yield stayed low. Debt expanded indefinitely. This wasn't a conspiracy. It was a structural equilibrium. But that equilibrium depends on one unspoken condition. Foreign central banks must believe U.S. treasuries are politically untouchable. Once that belief dies, the structure collapses. There are only four possible buyers of U.S. treasuries: domestic institutions, domestic households, foreign private investors, the Federal Reserve. Domestic institutions already hold about $6 trillion and face concentration limits. They cannot suddenly double exposure without destabilizing their balance sheets. Households hold roughly $3 trillion, and participation has been flat for years. Higher yields don't attract households when inflation erodes purchasing power. Foreign private investors face the same political risk as central banks. If reserves can be frozen, private assets can be too. That leaves one buyer with unlimited balance sheet capacity: the Federal Reserve. The Fed is supposed to be independent. It's supposed to control inflation, not finance government deficits. But independence ends where market failure begins. When auctions fail, yields spike, and refinancing costs threaten fiscal stability, the Fed intervenes. This isn't theory. It's history. And by late 2024, it was happening again. Officially, the Fed claimed it was shrinking its balance sheet, quantitative tightening. But the data told a different story. In early 2024, the Fed held roughly $5 trillion in U.S. Treasuries. By December 2024, that figure had risen to about $5.2 trillion. Even as foreign central banks sold nearly $400 billion, domestic buyers had increased. The math is unavoidable. The Fed absorbed the selling quietly, without announcement, without calling a QE. Its share of the Treasury market rose from roughly 20% to 22% in just 8 months. That may sound small, but it represents a 10% increase in Fed ownership in an extraordinarily short period. This is how debt monetization begins. Not with hyperinflation headlines, but with small, deniable balance sheet expansions justified as market stability. Once the central bank becomes a buyer of last resort, price discovery disappears. Yields stop reflecting risk and start reflecting policy. And when yields become political rather than market-driven, confidence erodes faster. Foreign central banks see the Fed absorbing supply and understand the implication. The United States is financing its deficits internally by expanding the monetary base. Inflation is the enemy of bondholders. As inflation expectations rise, Treasury demand falls. Falling demand forces more Fed buying. More Fed buying expand the money supply. And the loop tightens. This is the debt monetization spiral. And it didn't begin with a crash. It began with a quiet decision made in Brussels about interest. This does not end in stability. It ends in currency debasement. This is an ideology. It's arithmetic. And the numbers are unforgiving. The U.S. government currently runs deficits of roughly $2 trillion per year. But the true borrower requirement is far larger because existing debt must be refinanced. In 2024, total Treasury issuance approached $7 trillion. Before 2022, foreign buyers absorbed about 30% of net issuance. roughly $600 billion annually. Domestic buyers took about half. The Federal Reserve absorbed the remainder. After April 2024, that structure flipped. Instead of buying $600 billion, foreign holders became net sellers of roughly $400 billion. That's a $1 trillion swing in demand. Domestic buyers did not step up, so the Fed had to. To keep auctions functioning, the Federal Reserve effectively became responsible for absorbing the majority of net issuance. Once foreign selling is included, the Fed's effective share of new treasuries approached 70%. At that point, the Federal Reserve is no longer a participant in the market. It is the market. And when the central bank is the market has failed. That is a technical definition of a broken sovereign debt market. History offers no examples where this ends well. Weimar Germany financed deficits through the Reichsbank, Zimbabwe through its central bank, Venezuela through monetary financing. The scale and speed differ. The mechanism is identical. Market demand is replaced by money creation. Inflation follows. Currency credibility erodes. The United States is not immune. Reserve currency status delays the consequences, but it does not cancel them. And that status is precisely what is now being lost. The irony is that none of this required a visible crisis. No major bank collapsed. No treasury auction failed on television. The deterioration is happening quietly through balance sheet mechanics and custody flows most people never see. The treasury market still functions, but only because the Federal Reserve is quietly supporting it. That's why yields have remained contained despite unprecedented issuance. It isn't confidence. It's intervention. And intervention is never free. Every dollar the Fed creates to buy treasuries dilutes the purchasing power of existing dollars. Inflation doesn't need to explode overnight to destroy trust. A steady 7 to 10% erosion over a decade achieves the same outcome. Foreign central banks understand this. That's why they aren't waiting for crisis headlines. They're repositioning now, slowly, deliberately, and the pattern of who is selling tells you exactly where this is heading. China reduced its treasury holdings from roughly $1.1 trillion in early 2024 to below $1 trillion by year-end. This wasn't about yield. It was about survival. China watched Russia lose access to hundreds of billions overnight and understood the lesson immediately. Treasuries are only safe until Washington decides they aren't. With Taiwan as a permanent geopolitical flashpoint, China knows its reserves could be next. For China, selling treasuries isn't a financial trade. It's a strategic insurance policy. Japan selling tells a different story, but leads to the same result. Japan reduced holdings by roughly $100 billion, not because it fears freezes, but because it's drowning in its own debt. With debt to GDP over 260%, Japan needs domestic liquidity to finance itself. The most liquid asset Japan owns is U.S. Treasuries. But Japan has been the most reliable treasury buyer for 3 decades. When Japan becomes a net seller, the system is under structural stress. Saudi Arabia's behavior is even more revealing. Saudi holdings fell from roughly $135 billion in 2023 to about $90 billion by the end of 2024, a 1/3 reduction. Saudi Arabia isn't sanctioned. It's a U.S. ally. And yet it watched Russia's reserves get frozen and asked a simple question. What happens if our policies diverge from Washington's interests? Oil production cuts, yuan-denominated energy trade, closer alignment with China. Any of these could trigger political retaliation. Saudi Arabia didn't respond with confrontation. It responded with diversification, buying gold, accepting non-dollar payments, joining BRICS. The UAE, Kuwait, and other Gulf states followed. Combined, Gulf countries reduced treasury exposure by roughly $80 billion in a single year. This isn't coordination by conspiracy. It's coordination by fear. Each central bank independently reached the same conclusion. Treasuries are no longer politically neutral. So where does that money go? First, gold. Central bank gold purchases in 2024 exceeded 1,000 tons for the 3rd consecutive year, the highest sustained buying since the 1970s. China officially reported over 200 tons, with unofficial estimates far higher. Turkey, India, and Poland also accelerated purchases. The reason is simple. Gold held domestically cannot be frozen. Russia's gold inside Russia was never touched. Only Western-held assets were. The lesson was universal. If you don't hold it, you don't own it. Second, alternative currencies. The yuan's share of global reserves rose from about 2.3% in 2022 to over 3% by 2024, a 40% increase in just 2 years. Small in absolute terms, massive indirection. No one is trying to replace the dollar overnight. They're trying to reduce dependence. Third, real assets, commodities, strategic materials, energy infrastructure. Things with intrinsic value that cannot be digitally seized through a payment system. This diversification has a mechanical consequence that cannot be avoided. Every dollar not invested in treasuries must be absorbed by someone else. And that someone is increasingly the Federal Reserve. The United States now faces a mathematical wall. Annual deficits near $2 trillion. Total borrowing needs near $7 trillion. Foreign buyers shifting from plus $600 billion to $400 billion. That's a $1 trillion gap. Domestic buyers haven't filled it, so the Fed does. That's why the Fed's balance sheet is rising again despite tightening rhetoric. That's why yields remain artificially contained. That's why inflation refuses to die. This isn't a crisis yet. It's worse. It's a slow bleed. The timeline isn't months, it's years. 2022 planted doubt. 2024 destroyed trust. 2025 to 2028 brings accelerating foreign selling and rising Fed absorption. By the late 2020s, the Fed share of the Treasury market approaches 30%. At that level, markets price inflation risk regardless of policy promises. 10-year yields drift toward 6%, then 7%. By the early 2030s, interest payments consume the majority of federal tax revenue. The illusion breaks. The U.S. faces three choices. Default implicitly through inflation. Default explicitly through restructuring. Or cut spending at a scale that collapses the middle class. None preserve the existing order. This is how reserve currencies die. Not in a dramatic collapse, but through the slow erosion of trust. And once trust is gone, it does not return. The U.S. could restore credibility by placing reserves beyond political reach, limiting asset freezes, and surrendering the ability to weaponize the system. But it won't. That power is too useful. And that is a tragedy. By weaponizing the Treasury market, the U.S. destroyed the very foundation of its power. History has seen this before. In 1914, Britain seized German assets and weaponized sterling finance. The pound didn't collapse overnight. It took decades, but the process was irreversible. London lost dominance. New York replaced it. The U.S. froze Russia's reserves in 2022. If history rhymes, the dollar's dominance ends within 15 to 20 years. Faster this time, because technology accelerates everything. Payment systems shift in hours, not months. Reserve reallocations happen silently, not publicly. The catalyst wasn't Russia losing $300 billion. It was America losing the trust behind nearly $8 trillion in foreign treasury holdings, a loss ratio of more than 20 to 1. The U.S. gained leverage. It lost trust, and that trade can never be undone. The free lunch is over. The safe asset is broken, and the system replacing it will look nothing like the world we grew up in.